Joining us now is Peter Switzer, the founder of the Switzer Report. Peter, good to see you this morning. I have many questions and I'm going to start with this one. Why are the banks, what benefit is there in the banks waiting for 10 days to up to 3 weeks to pass on this rate cut yesterday?
Look, it can only be a bottom line implication. You know, it was a big thing for the big four banks to actually say we're passing on in full, but you know, delaying it has a impact on their bottom line, and it would have been better for the public relations aspect of all this to just pass it on as quick as possible. It probably always takes a week anyway to actually get it to go in the system, but it's not a good look, is it?
But I guess, you know, they might argue that they've already done the good PR thing by at least saying they are all going to pass it on. Did that come as a surprise to you at all, Pete?
Yeah, I got to say, look, I can bet you the Treasurer and the Prime Minister made a few phone calls to make sure that the CEOs of the big banks were onside. And it's a really significant thing. You know, we noticed that overnight the Federal Reserve went for an emergency interest rate cut of 0.5%. So this is a really important and scary moment which needs to be handled really well. And so that's why the banks jumped on board. It's a pity they didn't say, well, we'll do this ASAP, and that would have kept, you know, the jackals in the media away from the poor old banks. But, you know, giving us this opportunity to put the slipper in wasn't a great PR idea.
Well, perhaps not, but you're going to get that rate cut eventually, whether it's 10 days or 3 weeks. You did mention that emergency rate cut in the US overnight. We've seen markets not react favourably. Why did the US go so big?
Well, since 1998, guys, there's been 7 emergency cuts. That means that the Federal Reserve is cut before its actual meeting. And the big standout ones was, you know, 7/11. 7/11 is right. Well, September 11. Certainly the GFC as well. The dot-com bust. These are times when the Federal Reserve has really reacted, showing that they're all afraid of the economic implications of a shock event, which the coronavirus is. So that's why they've gone for a shock and all cut. You might be surprised that the stock market hasn't reacted as positively as you would have thought. The first reaction was a 700-point jump in the Dow. But in reality, the market dropped about 13% last week when we started getting spooked about coronavirus. It's now down about 11%. So what the market's basically saying, yeah, we're glad you're on board doing stuff like this to help the economy in the future, because the economy hasn't been affected yet, but it's going to be really affected over the next, you know, month or so. And so the Federal Reserve getting in, really important. But the pressure, and it's interesting, Jerome Powell has done basically what Dr. Phil Lowe, our Reserve Bank boss, has been doing. He started putting pressure on the Trump government to actually think about more fiscal stimulation. And I think that's what we saw, you know, locally with the Prime Minister announcing a stimulus package before the budget. And that's, I think, a really smart move.
How much lower can the banks go, Pete, in terms of interest rates?
They could go negative. The Reserve Bank doesn't want it. I don't think psychologically we want it as well. And so the pressure's now on Josh Frydenberg to basically come out with what I described yesterday as a budget bazooka. You know, I have noticed the language today is it's going to be, I think, targeted, measured and scalable. I don't want it to be too measured. They'd be better off just going really hard and everyone says, right, this economy of ours is going to be protected. A bit like the GFC with Wayne Swan, you know, started, you know, posting out checks and all that sort of stuff, and building of, I call them the Julia Gillard Memorial School halls. All those things helped Australia avoid a recession. And I would not be going too measured on the stimulus. OK,
what would you like to see in terms of a dollar figure? Because targeted would mean, you know, a couple $100 million, not in the billions like we saw in the GFC.
Well, I think, correct me if I'm wrong, but the stimulus linked to bushfires was going to be about $2 billion, wasn't it?
Yes.
So you want that number to be doubled, to a 4 or a 5. Now, I've got to say, in all honesty, I hadn't thought about it. But guys, this is really important. At the moment, we're talking about a battle between two sets of numbers. On one hand, you've got what the economy could look like, and remember, we get national accounts today. It'll probably be a small positive, but March will definitely be a negative, which will be the first move towards a recession. If we get another one in the June quarter, we'll see headlines of recession, which will be really bad for the economy. And what happens is when you get a recession, unemployment increases, so the government loses money anyway because people aren't paying their taxes and they're putting money out for the dole. So sometimes you're better off going hard early, and then maybe by the end of the year when things are going really well, you actually start even put a mini budget on and increase taxes if the economy is really rocketing on because you overstimulated. I would not be doing a sort of timid injection of money now. I'd go for a fair income bazooka.
Well,
budgetary spending.
Interesting stuff. Yeah, I tell you what, the people out in the regions or anywhere for that matter who are doing it tough at the moment, they couldn't give a hoot about a surplus. They just need money. Right. They need money. They need all kinds of help. Peter Switzer, thank you so much. We'll talk to you again soon.
All right, mate.